Welcome everyone to the Brandon Adams podcast. This is episode 31. I have with me Barton Wang. Barton, this is our third time together. Your episodes have been exceedingly popular. How's it going today?
Hey, Brandon. Thanks for having me on again. It's great to see you.
So when we left last time, you were thinking about launching a newsletter. Rather, you had planned to launch a newsletter. Now the newsletter is out. It seems that it has a good bit of traction. By the way, I should do a standard disclaimer now. Nothing that we're going to talk about is investment advice. I believe your newsletter does talk about sort of outlook for S&P and stuff like that. That's not territory that the show ever gets into, but nothing is investment advice. So tell me how the decision came about to launch the newsletter. I take it that once your Twitter profile gained 30K plus followers and your tweets started gaining exceptional traction, the thought crossed your mind, all right, how to professionalize this a bit. And the newsletter was a natural way. How has it gone so far?
It's been going pretty well. It's good to not to think about the virus anymore, now that a lot of us are vaccinated. And what's really interesting right now in the market is that the monetary policy and fiscal policy of the government has been influencing the market a lot. And very recently, in the second half of February and throughout March, we've seen a lot of influence, direct influence from the Fed, from the Treasury, and from the with GSE, the Fannie Mae and Freddie Mac, those guys who underwrite the mortgage-backed securities. They have been playing an outsized role in determining the day-to-day market direction, which is fascinating because it happened before, back in 2018, when we had the quantitative tightening last time, when the Fed was reducing the balance sheet size. But this time, we're increasing the balance sheet size at the Fed. And surprisingly, the market has went into some kind of a regime when the day-to-day or week-to-week movement was very intimately coupled with the day-to-day change of what Fed and what Treasury has been doing to their balance sheet. They've been throwing out hundreds of billions of dollars out for stimulus and for settlement purposes on certain days, and that immediately move the market by 2 to 3%, and that just fascinates me. And I think that's a very interesting market regime that a lot of money can be made if these moves are captured and forecast ahead of time. So since I have built this model for quite a few years, and I decided to launch this into a service, which also sharpens my own thinking, because when you write a newsletter, you have to do your research really carefully and make sure you understand everything and then communicate it in a easy to digest way for people to understand what is behind the scene, what is the plumbing system being working for the system, for the market.
Yeah, so it wasn't an accident that you established a large and devoted Twitter following. You tended to make short and medium term calls that came to fruition. And the logic behind it made a lot of sense. The fact that monetary and fiscal policy would be a huge driver in stocks, it made a lot of sense. I want to discuss some underlying assumptions of the model. Okay, you're saying that short-term movements in monetary and fiscal policy affect short-term stock behavior.
Right.
I was hoping we could go through possibly an illustrative example. We had this sort of black swan event recently of, I believe the pronunciation is Archegos Capital.
Yes, that's right.
So Archegos Capital, a family office that really no one had ever heard of before it blew up. It blew up in very dramatic fashion, and it was it was quite a story because it was literally just a pinprick that did it, right? It wasn't like, oh, we had these six sigma moves in markets and the fund got caught the wrong way and blew up. It was really like a pinprick, basically. So this family office that basically had no need to lever itself, they had enough money for many, many generations, decided to lever itself in extreme and blew up. And part of the story was that the family office had a large desire to gamble, and the gamble was being strongly accommodated by investment banks providing leverage.
Right.
So it seems to me this is an interesting illustration because your theory kind of relies on the idea that speculators will take the credit that's available and put it into financial markets. Is that a fair statement? Your view of the world, which I take to be correct, is that the reason that monetary and fiscal policy drives market movements in the short term is because it affects basically liquidity provision for major banks or the liquidity that major banks are providing to hedge funds and other market participants. And that is the mechanism by which it affects stock prices.
That's exactly right. I'm glad you mentioned the Archegos blow up as example here. So what happened given what the information we have right now, seems to be that it started with the blow up really started with the Viacom secondary offering,
which is a pinprick, right? I mean, this is what happened. Like it was a pinprick. It wasn't like bombs dropping on a city or anything outrageous going on. It was like a secondary that was offered by a company with arguably overpriced equity, and that was enough to start the dominoes tumbling.
Which is a correct economic reaction from that company's management perspective. If your stock price is way overvalued, let's just capitalize on that overvaluation and issue more stocks to the market. It seems there's a demand for that. Archegos levered itself up, I think, for quite a while, but between January into mid-March, they levered up by about 5x of their capital. And a basket of names, 10 very concentrated. A lot of these are Chinese internet names, also Viacom, Discovery, and a couple of American names. Some of the holding, it was so large, it went up to 35% of these names by Archegos alone. And you can probably argue that the entire move for Viacom, for example, from January all the way into early March, from that $40 all the way to $100 was most entirely the doing of Archegos' purchase of their stocks. So the float is kind of small in comparison with how much they bought. And they used a derivative product from the big banks, Goldman, Morgan Stanley, Credit Suisse, and Nomura. These are the names that are well known. I think Deutsche Bank also was involved. It's a total return swap, which basically allows them to trade these stock, allows the hedge fund or family office to trade these names like a future contract. You don't have to cough up 100% of the capital in order to buy these stocks. You can just buy the difference between the stocks future prices versus the price when you enter into the contract. So it's like a future contract for a single name, or CFD, contract for difference, for people who are familiar with that in Europe. And the banks Goldman and Morgan Stanley, they made a lot of fees out of it. If you look at the Goldman's Q1 earning report yesterday, their investment banking arm had a 60% return on equity for the first quarter of this year. 60%. That's a lot of those are coming from these derivative products they sell to their clients. Basically, they allow the clients to lever up. They extract a fee out of these products because the financing cost for Goldman to enter into these contracts is very low. And on their own book, they buy the underlying stocks for the clients, and then they short these underlying stocks through this derivative, because the clients along these derivatives, Goldman are short these derivatives. For Goldman on their book, it appears to be a zero delta position, meaning they're flat. They're unaffected by the movement of the stocks, but they have to pay certain price for that, which is the regulatory balance sheet cost. So if you carry the derivative, you also carry these underlying stocks. Your balance sheet, you have to cough out some capital in order to hold these positions on your book. There's risk associated with it. There are counterparty risk, for example. What if Archegos went bankrupt, and did went bankrupt, right? But these banks, they've been receiving a lot of stimulus money because their clients were receiving a lot of stimulus money from the government. And in order to boost their own earnings, they have been using this money to basically underwrite these derivative contracts to their hedge fund, to their family office clients. And through these leverage, we've seen a huge amount of speculation in the market right now. If we talk about, for example, inflation expectation or how much debasement we would think US dollar would suffer from all the money printing or the monetary expansion coming from the Fed and from the federal government through fiscal spending, we're no way getting a 10x or 6x increasing the asset prices. There's no immediate danger for US dollar to depreciate by factor of 10 or factor of 6, given how much money is printed. It's not a lot of money, but the asset price has grown up by 6x or 10x in many, many names. Bitcoin, for example, has gone up by 6x. Viacom before it crashes, it went up by 10x. A lot of these names are going up completely out of proportion with how much fiat money debasement we should expect from the money printing that has been conducted. So how this is done, which is fascinating, because if you can understand this, if you can anticipate this, then you can probably front run a lot of these trades and make quite a bit of money yourself. So that's why I'm very interested, and I'm still learning a lot from the market right now and studying this phenomenon.
When Archegos went belly up, the effect on the markets was sort of short-term complicated because they had basically been long these individual names but short the indices. So part of the blowout was like covering the index short.
Yes.
And then on balance, it's kind of bearish because the banks take big losses, $1 billion here, $1 billion there. And that sort of dries up their overall risk-bearing capability by a little bit. I mean, these are big banks, but it's not great when they lose a couple billion.
Right. Well, so this is also a very interesting situation. So I think the majority of the loss was borne by Credit Suisse and Nomura. Goldman and Morgan Stanley, as well as Deutsche Bank in this case, front-ran Credit Suisse and Nomura, and they didn't suffer much loss at all.
That was a very interesting aspect of the story. And so if Goldman takes the loss, then basically like their immediate risk-bearing capacity would go down by, roughly speaking, the amount of the loss times 20, right? Which would be right. The average amount that they would kind of lever up things.
That's right.
But if Credit Suisse or Nomura takes the loss, it's more complicated because it's international domicile or something, I assume?
Exactly. Their regulation is slightly different. The Fed is pretty strict on the balance sheet size for the banks. Japan, I believe they are being in a discussion whether they're going to extend the SLR exemption that we have here for another year. So for Japanese banks, they don't have an immediate pressure to be very careful with their balance sheet. Credit Suisse have this issue. They actually had this issue since January 1st. They are under the constraint that they shouldn't increase their balance sheets too large. But UBS already exceeded that. And they was like, okay, we don't care. If we exceed it, and then the Swiss regulatory body is called FINMA, didn't do anything. Okay, they could not do certain amount of buybacks or dividend payout. That seems to be okay with them as long as they're still making money. So UBS is already below that threshold. Their balance sheet is over 20x. It's about almost 25x, 23 to 24x of their capital. Credit Suisse is going to join the rank, probably already joined the rank as well because of the loss. And they probably will be. So here's how it's calculated. This is a regulation that where banks' balance sheet, the average value of that throughout the quarter is compared to their capital at the end of the quarter. So on March 31st, June 30th, etc. And this is looked at the bank holding company, so their commercial banks arm and investment banks arm added together. Look at this overall bank holding companies level, and their CFO are very sort of to be on top of this. And if they're falling below that 5% or 20, they exceed the 20x ratio, their ability to pay dividend, to do buyout will start to get impaired. If they give even more, the ability to pay out bonuses, I think that's a 3% threshold. If they're below 3%, they cannot pay out any bonuses at all. That will be impaired. So the bank CFOs will probably look at this very carefully and started to throttle on how quickly the balance sheet will grow. When the balance sheet is growing too fast because of their extending leverage to their clients, or when they suffer big losses. I think Credit Suisse probably look at it and realize they're close to the 5% limit. So they decided to defer this a little bit. So their unwinding did not happen at all until April 1st. I think the unwinding really stopped maybe on Tuesday this week. So they dragged this on for almost 2 weeks behind everybody, just so that for their Q1, their financial report can look better, and the loss will not be realized until Q2, which will probably is past the point of no return. So they're just gonna deal with it. But that made a very interesting market dynamic. We had a lot of, I would attribute 50% of the rally between April 1st through the Tuesday this week to the continued unwinding of Archegos position.
Really? I would be surprised by that, just because even if the S&P position was, or even if the ES position was 10, 15 billion or whatever, 20 billion, it seems like that would be absorbable.
The volume has been pretty low in the past 2 weeks. And one telltale sign of that is to do a correlation between the S&P future versus the names in that basket that Archegos has been holding. For example, GSX, which is a Chinese online educational company. Or if you do a correlation with Viacom, with Baidu, and you look at it, it has been anti-correlated until Tuesday.
That was the other aspect of this I wanted to get into was, since we chatted last, the battle of short sellers versus the rest of the market reached its culmination in GameStop. And GameStop sort of triggered the popular imagination. There were lots of stories about this. It was all over the place. So a decent part of the Archegos story is that he's actually taking super long positions in companies that are really popular among short sellers. Like I remember GSX had at least one prominent like short seller report written about it in late summer. And GSX was certainly a popular target among short sellers. So there was this, you think, part of his strategy to sort of target high short interest stocks, or did he just sort of randomly land on these companies that happen to be of interest to short sellers?
I think he just ran a thematic investment strategy to me. He picked a basket of names that are similar in a similar industry and relatively low in the float, and he really cornered the market. And this is the other thing about how the leverage being issued by the investment bank arms of the big banks. Because the stocks are held by the big banks and they were canceled by these short swap position the bank have with their clients, you will never see those in the 13Fs.
Yeah, that's what I was thinking. That was my next question was, I assume that it avoided the 13F requirement, and then, which I guess as a family office, Archegos didn't have, but then it would also probably avoid the 5% threshold.
Yes, exactly, because he's spreading it out to different prime brokers.
Presumably, the cost of entering into one of these is higher than the expected cost of basically having the position on your own books, like trading in and out of it. So, if that's the case, what is the motive? Is it simply this regulatory runaround?
It's the leverage. He can get cheap leverage. He can leverage up by 5x this way. Otherwise, if he carried on his own book, there's no leverage. If
you carried it on your own books, if you have a big decline in your portfolio, now your leverage ratio goes up tremendously. You might have some forced liquidation. Presumably, there's the daily capital settles or whatever that also provide for some forced liquidation.
Right.
Is that true? So it's sort of similar to holding the position.
Right. It is exactly true. And that's how the domino started to fall, because the Viacom liquidation, the Viacom probably triggered the first batch of margin calls, which then triggered the margin calls and then triggered false selling of his other positions, which triggered additional margin calls on the other positions, because those are falling out by 20% as well. And it just propagates and then liquidate his entire portfolio.
So going to a big picture issue that you hit on, you said banks are getting a big inflow because their customers are getting big stimulus checks. And basically, it's fair to say that if they were responding to this inflow by lending a bunch of money for consumers to buy things or lending to businesses, that would be inflationary, but instead they're basically lending it to hedge funds and other investors, and it's blowing up asset prices. Is that a fair generalization?
Yeah, that's a very good question. I like the conventional wisdom people may have is that when Fed prints money, when the U.S. government does deficit spending, that money will flow into commercial banks, which will turn into loans to consumer and companies, which will increase the monetary M2, right? The monetary base. And then we were limited by the fractional reserve ratio before 10%, which means you can lever this up, or you can have M2 equals 10x of the base money. And that's how inflation occurs. It's not happening at all. The total loan, the commercial loan, and a consumer loan issued by the U.S. domestic banks throughout this COVID crisis did not grow an iota. And if you look at Q1 data, it actually shrunk a little. So what's behind this is that the margin on these loans are so low these days, banks are just not interested in issuing loans, and the bank somehow perceive the risk is higher in issuing loans to consumer and to the business than letting the investment bank's arm to issue loans to stock speculators. I count myself as a speculator too, because these days, like the long-term investment theme is really hard to do with all the asset prices being completely inflated. And it's really just everybody's doing speculation, short-term speculation on the market.
Tell me if this is an unfair generalization of your model. The model is that an increase in bank reserves translates into an increase in security lending, which then translates into an increase in asset prices. And conversely, a decrease in bank reserves translates to a decrease in lending, which translates to a decrease in asset prices. And this plays out over a relatively short period of time. So you can take a look at, for instance, weekly changes in reserves and translate that into probability distributions of what's likely to happen for asset prices. Is that fair?
It used to be the case. In the past 12 months, ever since we started the COVID relief program from the Fed and also from the Treasury, the CARES Act and all that. But in mid-February, we kind of hit the ceiling, the upper bound of how large the bank's balance sheet can expand. And we somehow flip into this very weird opposite regime when the bank reserve, which is basically the cash that's coming out of the Fed and the Treasury, start to crowd out the allowance or the provision that the banks could give out for a hedge fund to lever up their position. So we get into a very weird opposite situation every time there's large inflow of bank reserve. For example, after the March 17th, there was $270 billion of money flowing into the market and flowing into the banks in one day from the third stimulus check. The market crashed the day after because the bank balance sheets was kind of overbloated, and their treasurers have to cut their exposure in other areas to keep their balance sheet in control.
So would you say that this regime is analogous to like September of 2019 at the time of the repo crisis?
This is actually this is worse than that. This is more like the 2018 QT situation where you have this very short-term 1 day or 2 day impact on the market because of a huge amount of money being released by the Treasury.
In terms of the mechanism, the model, it does require, if I'm correct, that basically market participants respond to improving liquidity conditions in predictable ways. In other words, if liquidity provision towards, say, hedge funds is more favorable, they predictably buy stocks, and if it's less favorable, they predictably sell stocks. Is that a fair generalization?
Yes, that's how it's working in the second half of the quarter for the most part.
And that if that has been sort of a cornerstone assumption of your models for some time. Am I right?
Only since mid-February. Since mid-February. And that's a very strong correlation. It's correlated way too nicely on a day-to-day basis. It correlated really well between February 15th through March 30th, I would say.
Do you have thoughts as to like why participants respond this way, or do you just take it as empirical, like the state of the world? Because there's nothing that forces people to buy a bunch of assets when liquidity is very available. Like you don't have to keep the foot jammed on the accelerator all of the time. So is it some sort of institutional incentives that that go this way, or has this just tended to be the behavior of U.S. capital market participants, that they're like as aggressive as they're allowed to be? Like, do you have any viewpoints as to why this is the case?
Very good point. Well, so first of all, this is a empirical observation. I wish I'm the fly on the wall of those big banks, treasurer's office, when they call their primary brokerage arms to reining their leverage or lending to their clients. But what we can see from the bank's balance sheet data back in February and March, which Fed reports those with a 2 weeks delay, you can see them actively reducing their balance sheet size with respect to their bank reserve. They're actively actually cutting down their balance sheets more every single week. They cut more on their balance sheet when the bank reserve is going up. They have relatively little control of bank reserve. When the federal government is sending out stimulus money, the bank cannot say no, right? They have to take it in. And once they take it in, and it's in big quantities, because we're sending out hundreds of billions of dollars on some of those days, then they have to do something to the rest of the balance sheet. And the way I look at it is this. Well, once you have a couple of banks, big primary brokers, unable to extend more leverage to their clients, and then they wish their clients will reduce their exposure, then any catalyst in the market, any stalling pressure, you'll find no buyers. And that could trigger a pretty substantial move in the market downwards. It will recover later on, right? Because this is temporary, banks will be able to push their reserve to, for example, money market fund, which will be able to take these money and put in Federal Reserve's reverse repo program, for example. That takes time. That takes a couple of days to complete, to push tens of billions of dollars to other places. So just during those time when they were struggling with their balance sheet, if there's any catalyst in the market, it tends to become a amplified move, and it moves down. And if you have a 5% move in the market, that's plenty to profit from it, because fortunately, the implied volatility of index options are still very low. This is something that also related to the GameStop you mentioned earlier. Yes, GameStop moves a lot. It still moves a lot for that name. But it's really difficult to make money out of that name, even if you have a good model, because the implied volatility of that option is way too high. To make good return on your bets right now is on the index options, because the index option has an implied volatility of about 20%, 28%, and sometimes 17% on SPX. But GameStop has 100% implied volatility. So all the calls and puts are way too expensive, and the risk reward ratio is just not good for GameStop. It's very useful. GameStop is still very useful signal to let you know whether the market is in the risk on and risk off move, especially for the intraday movement of market. You will see that the risk on sentiment recovers first in these highly speculative names than the index like SPX or QQQ. But it's hard to profit from those moves on the single names itself. The index, in my opinion, is much easier to profit from.
So if we take a snapshot in time right now, what are the liquidity measures that you are paying close attention to and you're writing about? Because subscribers to Liquidity Matters, they are getting outlooks on the basis of the short-term effects of Fed policy and fiscal policy. So why don't you take listeners through exactly what you're writing about week by week, and like what is important at this moment in time and for maybe the next couple months that you think you're going to be paying very close attention to?
Very good question. So one of the most important thing is the bank reserve levels for the big banks. For the big banks who are the top 10 prime brokers. We don't have that data. Nobody has that data except for these banks themselves. They don't release it. Fed doesn't release it. So the closest proxy for that will be the total bank reserve of all banks that has accounts with the Federal Reserve, including foreign banks, including smaller banks. And this is the case. This is helpful because so far, most of the large inflow and outflow of the bank reserve is caused by the stimulus and tax of the federal government. Today is a tax day, so we're going to see about $60 billion of outflow from the banks into the Treasury's account. 60 billion is today is the estimated tax due date for the first quarter, right? And on the 25th, you're going to see a huge outflow from the Fannie Mae, Freddie Mac, these mortgage-backed security underwriters to the banks when they pay out the mortgage prepayment interest every month. That's about 170 billion for this year. That's a big inflow for the banks and bank reserves. These are the days I track, and these are the large inflow and outflows that could move the market when the banks are concerned about the balance sheet size. I don't think they're concerned right now for April because this is the beginning of the quarter. They need to make money. They need to increase their profit for this quarter. And the biggest profit comes from, investment banking, which is giving leverage to let your clients to speculate for now. And they will average out their balance sheet size later, for example, in the second half of May and in June. That's when the time comes and they will start to sell or force their clients to close their positions. And which we can actually see that since the beginning of this year, every single month's end will have something to blow up. In January, it was GameStop shorts blow up, right? In the second half of February, that was a huge sell-off in ARK, Cathie Wood's positions, and it's still pretty low. That entire basket hasn't recovered yet. And in late March, that's Archegos, right? Even though right now in April, we're in the risk-on move and things are just going up and up for especially for the blue chips names. I think when we hit the second half of May, the bank will freak out again at their balance sheet size, and they will have to trim. And at that point, we're gonna just track the total bank reserve very closely and look at their day-to-day movement. As soon as the correlation between the index with the stock index with the bank reserve levels reestablishes, that will be a good time to make some really short-term trades. And at that time, I think we'll probably see some nice correlation between the two, just like the second half of the February and most of the March.
Now, can you take us through the fundamental accounting that implies that, say, a big influx of stimulus checks will force the bank to curtail activities? I take it that it's basically you have the bank equity, which is what it is, and goes up slowly as the bank records profits quarter by quarter or what have you. And then that equity can support an asset base of roughly, let's say, 20 times the equity, and basically is the way to think about it that when the stimulus checks come in, that's an increase in demand deposits that the bank holds, and demand deposits are liabilities. So like they have to, is it just that simple?
Yeah, that's exactly the case. And then banks sometimes can forecast the inflow and anticipate for it, so they can do some proactive maneuver to trim their balance sheet a little bit. But sometimes they really have no idea who will get the money at what time. For example, the stimulus check. It's not entirely clear what clients will get it and what client will not. And then they have to do the balance sheet management afterwards. So for the accounting part, for the banks, a typical number. So let's look at, for example, JP Morgan. They have about, as of March 31st, $237 billion for their capital. And their balance sheet size is about $2.8 trillion. This balance sheet, different assets are counted differently. The derivatives are counted differently from the for U.S. Treasuries, and it's counted differently from the repo exposure. So every different type of assets is counted using different accounting. The deposit for them is counted as 100%, starting April 1st as a balance sheet. And at the same time, that is also the lowest yielding asset for them. So it's only yielding 5 basis points for them from the IOER, the interest over reserve that the Fed is paying out. They're also paying 17 basis points for the FDIC. So this is literally an asset for them that has really, really no margin at all.
So they don't want deposits, and your theory also is that they don't really want to do loans because that's low margin as well.
Yeah, they don't want to do, but they have to keep. The deposit basically was force fed by the government to them through their clients, a lot of times, right? So once we're hitting this, we're at this balance sheet ceiling, and they want to keep their ability to pay out dividends and do buybacks. They want to make sure that the balance sheet can be trimmed down into appropriate size every time they were force fed, and that becomes a selling pressure on their derivative desk.
And so, what is the accounting for like a prime brokerage activity? So let's just take a simple example where they have a prime broker client, and that client it runs levered 2x. So they just have $1 billion and they run $2 billion long, and it's done through the prime brokerage account. What is the accounting for that?
The current accounting through Basel III is that the notional exposure of the derivative times 5%. That is entered into the total balance sheet calculation.
But what if it's just an equity position that is the prime broker is lending $1 billion, and the hedge fund has $2 billion long exposure on $1 billion in equity?
So let's take Archegos as an example again, right? So assuming they had a 10 billion exposure, I'm simplifying things a little bit. Let's say they have a 10 billion exposure with Goldman on Viacom and Discovery and all these names. Show the swaps. Then for Goldman, it was 10 billion exposure in the derivative that was sold to Archegos, and 10 billion exposure for the equity that they're actually holding. These are netting out, assuming there's no counterparty risk from the Archegos. But for Goldman, there is a 5% balance sheet cost for the derivative part. There's a 5 to 6% cost on the equity part for Goldman as well. So that part does not net out. Just by holding that thing for the clients, there is about 12% times the $10 billion notional value. I'm adding the two together. So, but that's about $1.2 billion of balance sheet cost for Goldman.
In the pre-Dodd-Frank days, like the bank would respond to equity or liability changes by possibly responding in their own positioning, like their own trading. And then in today's world, they sort of do it via their prime brokerage lending activities.
Right. Pre-Dodd-Frank they do it directly because there was no balance sheet cost like this. Now there's a balance sheet cost, and this is the most efficient way for the primary brokers to carry these positions. So you see a much greater use of total return swaps and portfolio swaps. And Pre-Dodd-Frank, investment banks can net a lot of these exposure out. They didn't have to do this so-called supplemental leverage ratio calculation every quarter. They only need to do a risk-based leverage calculation. Now they have to do this supplementary leverage ratio calculation, which doesn't care about your risk exposure and doesn't care about your netting. It's like your notional exposure, a certain percentage have to be covered by your capital.
In your world of liquidity flows, let's just suppose that everyone like followed closely your model. What would be the news releases that would be especially important? Like, what are the news releases that you get fired up about in terms of inputs for your model?
You mean the surprises or the big events that will showing up? That will show
the big events that are weekly or monthly news events like data updates.
Of course, the most exciting thing will be the large liquidity changes to the bank reserve. Usually happens in the second half of the month. There are several sources of that. So Freddie Mac and Fannie Mae, they do a lot of those prepayments and the principal and prepayments cash flow in the middle of the month and then again on 25th. That's one of the big things I've been watching nearly every single month. As soon as the correlation between SPX and the bank reserve reestablishes itself in the second half of the quarter, that's something definitely really worth watching. And because we're having such a huge refinance activity right now, if you look at the mortgage-backed security origination, we actually increased threefold in comparison to 2020 levels right now. That's like 180 billion dollars of money being shoveled around every month on the 25th. That's a big one. Also, various tax dates from the Fed, big payment from the stimulus. Those can add up to, those are smaller in a single day flow, but over, let's say 3 or 4 days, they could add up to quite a large number, like 120, $150 billion. So if we look at the liquidity forecast model I'm having right now, looking into the future, we're actually in a very rare situation. Past next Tuesday, we'll be in a rare situation. We're going to have about $600 billion of inflow into the reserve nearly every single day from next Tuesday all the way into the first half of May. And last time that happened, it was August of last year when we had that big rally in the stock market, and then ended up with a huge correction in early September. So if there's if there's a cumulatively a large move from the Treasury because of its spending pattern, that's something I'm watching for. And often, also something I watch for is sometimes there's a big payment day and big expense day from the federal government. It's just back to back, large. So, for example, yesterday we had $120 billion coming out of both Fed and the GSE into the banks. And today we have about $130 billion going back into the Fed because of how GSE run their prepayment, they call it remittance day flow. These are the cancellation events. I watch them as well. It's just if the market moves have a sort of a false breakout and things like that, it's a good time to do a counter move. But I don't think it's right now. The market is driven a lot by the liquidity flow directly. It's more by the option market and how people speculate using the seemingly cheap money from the big banks.
I want to get into the option in a bit because you have a second newsletter that you're developing that relates to options effect on the market as a whole. But I want to talk a bit more about this liquidity transmission mechanism. So you're saying that we're at a point of tightness such that, let's say, a new round of checks is issued tomorrow, surprise, like everyone gets another 600 in their accounts, that increases liabilities for banks, and so they will tend to cut down on their prime brokerage activities or securities lending, and that will tend to be a negative for stocks at this moment in time, like a very short-term negative.
Right.
But
it'll bounce back later.
Yeah, it'll bounce. So that's the part that I wanted to get to, because that logically is a bit of a disconnect. Like if you print money and give it out to people, that would seem to be inflationary and should be good for equity prices in the long term.
It will be inflationary only if the M2 grows by the same amount, right? If the M2 does not grow at all, if we look at the M2 for the past 15 months, right, starting from the COVID crisis, M2 grow only by about 3 to 4 trillion, which is equal to the US deficit spending. So M2 was pretty much entirely coming out of the federal government deficit spending. Nobody else is creating money.
Yeah.
So it's a very mild growth. And that's why we haven't seen a proportion, like the US dollar hasn't devalued by a factor of 2, even though the Fed balance sheet grew.
I was going to get to that. So that's an interesting thought exercise, is what would happen if the liquidity provision by banks was used to buy all foreign assets instead of domestic assets. That would tend to be very dollar negative, right?
And it's happening right now in the past couple of weeks. That dollar has crashed quite a bit because the recent liquidity flow seems to be going more to the foreign banks as opposed to domestic banks. And so we need to have foreign banks to take up more bank reserves in order to have dollar to devalue more. But the foreign banks, if you look at the recent table I made for the top 10 prime brokers, foreign banks like Deutsche Bank, Barclays, UBS, BNP, they are all bloated in their balance sheet size too. All of them already breached their 5% limit on SLR. And their own central banks are also printing money as well, increasing the supply of their bankers' reserve. So every single banks out there, pretty much, except for like Wells Fargo and BNY, they are too bloated in the balance sheet, and they don't have a lot of room to take in more cash from the federal government. They could temporarily take some more, because like Japanese banks, they don't really care, but a year later they will have to care. And they're probably planning for that too. They're not completely letting loose their balance sheet size and just let people to deposit money. So we need more foreign buyers of US assets so that the US dollar can flow out if you want inflation. And
I want to dip back to the Archegos example for one moment, because securities lending has always thought to be very profitable, in part because the collateral was so reliable and the prices were freshly marked moment to moment. So if the loan was in danger of not being paid back, the creditor could liquidate and get the money back. And so it was not quite risk-free lending, but like almost risk-free lending, right?
Right.
And in the great financial crisis, we saw the dangers of kind of lending on very liquid assets, and we had the banking sector decimate its equity by loaning on real estate that declined in price. No one really knows the nature of security lending at the banks. Archegos is like a first shot that says, hey, maybe the securities lending is a little bit looser than we thought before. Do you see like systematic danger, like whoops, we blew up a lot of equity because we had more securities lending than people thought on looser terms than people thought, and like stocks went down and it wasn't our fault, and like boom, the equity's gone?
Yeah, it's coming. It's coming. I don't know when. I think there's a pretty high chance, like 72% chance happening in the next 2 or 3 years. So the analogy you drew is very good, actually. So back in 2008, a lot of it was AIG, right? So everybody thought they bought the CDS from AIG and they're safe because the risk was basically laid out to AIG. Nobody thought about the counterparty risk from AIG. What if AIG cannot pay all these credit defaults off, right? This time it's similar from the Archegos problem. It's like everybody thought Archegos will be able to cough up new capital if the stock moved too much, but nobody thought it was too concentrated in Archegos. They wouldn't be able to repay, and it didn't. And Credit Suisse suffered about $4.7 billion, maybe even more loss from that. And nobody is regulating Archegos. AIG was bailed out last time. This time, it's more like an LTCM situation, but luckily it was small, Archegos, relatively speaking.
Well, and it didn't tip over dominoes, right? It didn't lead to distressed selling, causing prices to decline, causing more distressed selling, causing prices to decline in that Minsky moment kind of way. It was very isolated.
It was almost there. I got some panic calls on that Friday when it first started. It was when people wasn't sure which bank has what exposure. It was pretty close. But luckily, it wasn't affecting U.S. banks. So.
And people were panicking because the moves in the individual names that were being liquidated were so large that it seemed weird, right?
And there were rumors that Goldman and Morgan Stanley may have huge losses.
Last thing before we get into the options market and the options newsletter, I still see that the transmission mechanism relies on the idea that if credit is available, the funds with access to credit will use it to buy assets.
Right.
And no one is forcing them to do that. So I guess like as this has gone on over the past year and assets have become broadly inflated,
right?
Do we expect this mechanism to continue to hold? Because I grant the idea that empirically it does seem to hold. I'm just wondering, is it just an absolute compulsion to buy these assets? Like, why is it that the funds don't just say, I get it that there's a lot of credit available at attractive terms, but there's nothing I want to use the credit to buy?
That's a very philosophical question. Given what I've observed so far, I think the appetite for more risk is still very large. Just look at Bitcoin, for example, right? It has already gone up by 600%, and it's still going up, and nobody is worried about that. US dollar is not devaluing by 6x. It hasn't devalued by 6x in the past year, and it's not going to devalue by another 6x in the next year. But many people are believing that the Bitcoin has no problem going up by another 6x. Not me, but many people are believing that. So if you look at the mechanical forces in the market, for example, risk parity, if you look at some risk controlled fund, they tend to believe that when the realized volatility drops, the market has to go up. So they pile in even more. They increase their leverage. CTAs have certain momentum chasing strategies. All of these are pretty large forces that kind of doing the self-fulfilling prophecy of buying begets more buying. They'll take up whatever leverage that's provided to them. And then back to your question about this money creation earlier. I think right now most of the money creation is happening in the asset market. because the lending for leverage for speculation, that's lending too.
Right.
And it's highly profitable for the investment banks. So why not? This is not lending happening for the real economy. This is not lending for the main street. This is lending for speculators, and it's cheap and it's making tons of money for the banks. So the banks are focusing on doing this.
Right.
And that's money creation too. We don't track that in M2 or even in M3, right? Because this is like the margin debt. This is like the shadow banking system through repos, through this swaps, through derivatives. They're creating buying powers.
Talk to me about your upcoming newsletter. You have had two major parts to your model in the past. One is liquidity conditions related to Fed and fiscal policy, and the other part is option market behavior. Liquidity Matters, the newsletter that's been out for a couple of months, has focused solely on the liquidity conditions piece. And then you're doing a separate newsletter to focus on the option market piece. Talk to me about that newsletter and whether you kind of need both parts of the picture, how those two newsletters are going to work together.
For me, I looked at how the equity market works right now. Is that it's basically there are two main driving forces. One is the monetary and fiscal policy, which is what Fed Liquidity Matters newsletter is about. And the second piece of puzzle is the option market. The tail that wags the dog being the underlying stocks and stocks indices, which it has been the case since 2015, 16, when weekly stock options has been like widely traded. And this is very sort of a very interesting phenomenon because the market keeps changing in its regime where sometimes it's the index options, which can have hundreds of billions of notional values every month at expiration, leading the charge of what is moving the market. The rolling of these the option positions every month from either more recently is people speculating on the calls, and previously in 2018 to 2019 was the rolling of the callers, the out of money puts they buy to hedge their positions. These got rolled every month. These rolling of the positions, the hedging behavior of the market maker of the options, you hear a lot of people talking about the gamma of the market. That kind of play outside a dominant role in the stock market movement in the short term. So much so that every month you look at the option expiration cycle, it's very similar. Near the monthly option expiration, you have a certain market behavior, and after the option expiration, you have another different behavior. So generally speaking, it used to be that the market is relatively moving very little before the option expiration because how the market maker, their hedging behavior kind of clamps the market down, and after the option expiration every month, the market will be free to move a lot more. And in the case of that happens for the second half of the month, and oftentimes that's a pullback or correction will happen, right? This has changed quite a bit in the past 12 months when people start to speculate a lot more on single names, on individual stocks that underlies the indices. So SPX, QQQ, those options kind of retreat back a little bit to the second place, and then some of the single name options, they can be sometimes with extremely large open interest. GameStop's these names, when they were heavily traded, their open interest sometimes was higher than the SPY open interest near the money. So they have a huge amount of money flow into there, and these derivative positions, and they're rolling, they're behavior, people close and open those positions, move down the line stock prices. So because a lot of these data is processable, and we're seeing on years of these data, this helps a lot in forecasting the short-term direction of the market in terms of what the market is going in the next week or next 2 weeks. And I think that's sort of a large part of the puzzle for where the market is moving right now.
It's always been a part of your approach to put the two pieces together. How do you recommend that your followers put together the information from these two newsletters?
So the option part is more in the driver's seat longer than the Fed liquidity. That's what I rely on most, if even without knowing what else is in the driver's seat. But so the option market is kind of the information there. You are following a bit to the market. There's what's already there in the option market, and that causes a mechanical flow. Either it's rolling or delta hedging from the market makers or people profit taking from their existing positions. And then there are people who establish new positions. You also have to track the volumes of new trades being placed every single day. And that's a little bit following, because you're following the big whales and what are the main positions people are doing. It's a little slow. The Fed part is not working all the time. It only works when the bank's concerned about the balance sheet, right? So it works maybe 40% of the time. But once that one is working, once that is in the driver's seat, the model gives you a roadmap for what's going to happen in the next 4 to 6 weeks with very high accuracy. You know exactly how liquidity is going to fly, because Fed and Treasury and Freddie and Fannie, they have a very predictable cash flow pattern. So when that is in the driver's seat, it's amazing, because then you can then use the option together to make a huge amount of profit from the market.
Talk to me about practical aspects of subscribing. Who is your intended audience? Where do they go? I noticed that you didn't use Substack, which is the popular option for most newsletters right now. Right. Where do people go, and who is the ideal audience?
Yeah, so for people who are interested, they can sign up at this website called fed.tips, fed.tips. This is the address for the website. And it's a newsletter. There's a free preview version, which basically laid out the mechanics of the theory part of how the money market plumbing, the big banks' roles in the leverage provisioning, all these theories, and some of the reviews of how the market has behaved under these influences. These articles will be free for everybody who sign up, and they can read the articles about that. And then paid members will get a forecast for the liquidity flow in the next 2 weeks, and my commentary on how that may affect the market, mostly on the equity market and sometimes on the rates and foreign exchange market as well. So I didn't go with Substack because I want to have my own address and have sort of better control on how the comments, how the site looks like, and potentially adding more information. So for the option part, I think I told you before last year, but I was planning something like this. There's part of it will be an app it's going to be a web app, and potentially also a mobile phone app that you can get alerts on these option trades. And so in order to integrate all of this into a same interface, I've been working, getting these, so I need more control on my website, and therefore the newsletter is using Ghost, a different platform to send out emails and to publish, as opposed to the Substack.
That makes sense. Substack requires a very strict template. You're not allowed to, or from what I've seen, you can't really add much in the way of graphics, and it's got its own look to it. It's very streamed down, a lot like Medium.
Right. Yeah. It's very organized in the way that Substack's newsletter need to look like.
All right. Well, this was a lot of fun. I hope to have you back on once the new product is up and running, once the app is up and running, and we can chat about whatever craziness has ensued in those months.
Yeah. Thank you for having me on again. It's a lot of fun, and the market has been pretty crazy, and hopefully people will be able to profit from it.
All right. Chat soon.
Take care. Bye.